Hi friends, I am Lalit. Welcome to my channel Flirting with Finance. Here we make money, investing and wealth building as exciting as a first date. Today, let us see a simple stock market ratio, price to book ratio. First, let us understand what is book value. Imagine your friend is starting a business. He is investing 10 lakhs of his own money and buying raw materials and equipments. That 10 lakhs is what the business is worth on paper. That 10 lakhs is called the book value. So book value is 10 lakhs. Now let us see what is the market price. Suppose the same friend is now selling the business but not for 10 lakhs but for 30 lakhs, and the market is also willing to pay 30 lakhs. So that 30 lakhs is what is called the market price. So P by B ratio is market price per share divided by book value per share. So in our example, P by B ratio is 3. What does this 3 means? It means we are paying 3 times what the stock is worth on paper. So how do we interpret P by B ratio? A low P by B ratio means the stock is undervalued, but that's not the case always. Sometimes a stock may be available at a low P2B because of its poor profits or some other underlying problems. Similarly, a high price to book ratio does not always mean the stock is overvalued. Sometimes the investors might be willing to pay more for the future growth. So always remember this: low P2B is not always cheap, and high P2B is not always expensive. So the real question is, does the company creating a value from its book value? So before you fall in love with a stock, always see whether the stock is creating a value or not. Thank you. If you like the video, like, subscribe and share with your friends. Let's make money fall for you.